The Zacks rank, value, momentum, growth, and income all factor into Zacks rank buys.
Where there is income, then there are dividend stocks. That's what we're going to talk about today with Ryan McQueeney, editor of our Income Investor Service. As a matter of fact, Ryan, you're going to fill us in on a couple of low-priced dividend stocks, right?
Yeah, I think low-priced stocks are interesting to talk about in the conversation of dividend investing because you'll often see some interesting low-priced stocks under $20 a share, come up on certain dividend screens and any income investor's radar because they typically have these juicy yields if they are a low-priced stock because their stock has fallen under one of these benchmarks. As the stock price goes down, the yield on the dividend obviously increases. And so it's an interesting relationship. I'm not sure that alone tells us much, but I have two examples today of stocks that are under $20 a share, sporting Zacks ranked #1 strong buys, and have above average dividend yields. And I'm just going to explore them both and look at some key concepts.
All right. Well, how many times have you heard, right, since you've been doing this for a while, just because they're low price doesn't mean they're necessarily good, right?
Right, exactly.
Not the case with what you're going to talk about.
Well, in a lot of the cases, it's the exact opposite. They're low price for a reason, and you want to avoid it, and you don't want to get stuck in that deep value trap. But yeah, these have Zacks ranked #1 strong buys, and though they certainly aren't perfect, and I think for each of them, really, I'm going to bring something up that it might make you hesitate. They have some positives and some good dividends to them.
All right, let's start with Steelcase Incorporated. This is an office furniture maker.
Yeah, absolutely. It's also headquartered in my former hometown of Grand Rapids, Michigan. So shout out to the Steelcase employees that I know personally.
Right.
So
send some furniture.
Its annualized dividend for the 2018 period is yielding around 3.3% right now.
Okay.
Not crazy high, but certainly intriguing. Stock's only trading at about $16.23 at the current period in time, so it's definitely on these like stocks under 20 types of radars right now. I think the first thing I would talk about when you look at a low price stock in any sort of situation is to take a look at the chart, specifically our price consensus and EPS surprise chart. So that's what I want to do with Steelcase here. And the one thing that I like about it right off the bat, though it's been whipsawing up and down over the past 5 years, and that it's had these steep drop-offs. We had this earnings miss here in late 2015 that just pummeled the stock. It seems to have these wild swings from lows to highs, and specifically we're well off the high here that was caused by what have it a wild swing, a huge earnings beat. We're well off that now, but then we're off this low significantly too. So it seems tough to get a grasp of the long-term direction of this stock, and it's been a while since it's had some type of long trend you can latch onto. But this isn't a stock that has consistently fallen over the last 5 years and brought it under that $20 a share benchmark when it used to trade much, much higher than that. So that makes us feel a little better. And more specifically, we like the fact that, as you can see in here, these earnings consensus lines for 2018 and 2019 are up significantly over the past few months, despite the stock kind of whipsawing back and forth. So that's why we have the Zacks ranked #1 strong buy on the stock right now. Estimates for 2018, which is a weird fiscal year. They might even call it their 2019. The one that's ending in February next month, that's up 6 cents over the past 6 days. Estimates for 2019 or 2020, the following fiscal year, up 3 cents in the past 60 days. This trades at just 14 times earnings, which I think is a really interesting thing to look at the earnings picture in the value case, because the other thing I want to talk about with the low price stocks, and I think this factors into the equation more when it is that struggling company that has been moving in the wrong direction, is the health of the dividend. So one way we can look at that is through our Zacks research system. We have a dividend analysis sheet, a dividend analysis form on the Zacks research system, and it shows us a lot of really interesting things. First of all, it shows us how the dividend changes over time. We can see it broken down by quarter here, but we can see it on a yearly, annual basis as well. 54-cent annualized dividend for this year. That's up from 51 cents, up from 48 cents, up from 45 cents. It seems like they're adding 3 cents on to the annual payout pretty consistently here. We get these annualized dividend growth rates, 5.9% this year. Over the last 5 years, it's averaged 6.5%. That's pretty solid. It shows a commitment to the quarterly payout. I also like the payout ratio down here. This is a percentage of the earnings paid out to the dividend. 49%, that's half of the earnings almost paid out to the dividend. It's not crazy high. It's not the best figure. I'd say anything under 40 is really impressive. 50 is kind of right on the border of maybe not so great, but as long as you can secure earnings growth, commit to raising the dividend, being right in that 50% range isn't too bad.
All right. What's going on with this casual apparel retailer you've uncovered, Buckle Inc.?
Yeah, so it's Buckle. You haven't been in a Buckle in no?
Can't say that I have.
Okay, well, maybe not quite your style, but BKE is the ticker, a specialty retailer, casual type of apparel, as you mentioned. This is a weird one for dividend investors because they pay out this 25 cents per quarterly dividend, and then on the holiday period, they do this one-time dividend that I think fluctuates based off of what they're seeing with the holiday shopping trends. So the 25 cents a share, that standard, basically guaranteed dividend, as we'll get into with our dividend analysis in a second, brings you $1 annualized. That's yielding about 5.6% right now. Plus, then you get typically that additional payout, which can fluctuate, but it gives you an even better yield. We're actually past the ex-dividend date for that special payment now, but if you're thinking about it right now, what do I want to get set up for the rest of the year's payments? Hold on long term. It might still be on your radar. Stock that's only at $17.60 a share right now. These people that are looking for these under $20 stocks, $15 a share stocks, might be interested in Buckle. The downside to this is it has that chart that I was telling you that you don't want to see. So this is not the pattern you want to see really in any chart when you're trying to pick a stock. This starting at the top left corner of the chart and slumping down to the bottom right corner of the chart. That's the wrong direction, especially when it's the share price and the earnings trend moving in that direction. This was just a few years ago a $55 stock. It's now, as I said, almost a $15 stock. Now, this is a Zacks ranked #1 strong buy. The earnings consensus for 2018 and 2019 trending higher in recent months. Think long term, you're hoping that this mid-2017 low holds up both for the earnings and the share price. We'll see if it does. The estimate revisions have been favorable, so that's a good thing. The other thing, though, to be concerned about here, I think, is what we can see on the dividend analysis, and that's that the payout ratio it raises a lot of questions for me. This 100% payout ratio, I think, doesn't necessarily hold up because our dividend analysis is kind of thrown off by this special dividend, but a little bit higher in recent years with a little bit less dividend growth in recent years. I think that special dividend was actually lower, about half as much this year than it was last year. So when we look at Steelcase able to consistently grow at a consistent rate and maintain a relatively same payout ratio versus your payout ratio increasing while the dividend isn't necessarily doing the same thing, that's the troubling type of trend, and you worry whether they have the earnings growth potential to keep these dividend investors around.
All right. Do you own either of these?
I do not.
Okay. Thanks for the information and for explaining all of that to us. Don't forget, there's always more stock information on our website, Zacks.com. Get over to the homepage and check it all out. Don't also forget that Ryan does a technology podcast called Tech Talk Tuesdays. Boy, that's a tongue twister. And it's on the podcast page of Zacks.com. Interesting tech information there. And then his free lunch streaming video series that airs Monday through Thursday, normally, except when we have brutal temperatures here in Chicago and can't get in, but generally available on most major streaming services. With Ryan. I'm Terry Ruffalo.